So just to pick up on the slide that we finished on last time, we want to look at that CPI select categories and how we've seen gasoline and fuel, that energy component really accelerate. But then when you look at the CPI year on year, rent, owner's equivalent, food, hospital services, fruits and vegetables, you're still seeing those increases, but that first bump is on the energy front. Now, one of the things that we've talked about is that then bleeds down to everything else. So it starts there, but gasoline, people use gasoline, diesel, people use diesel. As you start to look now, as we prepare for the shoulder season into the winter seasons, are we going to have enough distillate? What's that going to look like? And again, these are some of the key pieces we want to look at when we're discussing nominal versus real wages and the spending capacity that people could possibly have on a wages front. So now when you look at the small business side, small business survey respondents raised selling prices in August for the first time since November of 2022, the largest month-on-month jump since May 2022. And this is what we've talked about. You're starting to see the higher prices and the monthly changes picking back up. Now, some of these could have been through sales, because it's all a matter of these adjustments, but now we're seeing it pick back up. All the while, we're starting to see wages start to roll over a bit, and we want to talk through that a bit more. July business inventories came in flat versus the estimate of 0.1. Wholesale inventories came in at 0.2 versus the prior of negative 0.7. Retailer inventories came in at 0.2 versus the positive 0.2. So again, inventories still elevated, still normal, but a lot of this is, you're not going to get a lot of manufacturing. You're not going to get a lot of ordering coming forward. Instead, you're going to see those slowdowns really continue to ramp up as the retailer isn't going to be spending to the same degree. Now, wage growth tracker by industry, the median U.S. asking rent in August was $2,052, just $2 below record high set a year earlier and up from $2,038 a month earlier. So the rate of change might have eased, but again, you're still seeing on a real terms basis, that's a big number. But then look at that wages piece, the wage growth tracker. On a percentage basis, we're still coming down. We're still falling in that metric. So yes, you're still growing to a degree, but now you've fallen back below inflation as you're seeing some of these big ticket items go up in value or up in cost, which is eating into the actual ability for individuals to spend money. So then the single most important problem is still inflation and quality of labor for the small businesses. So as of August, quality of labor remained the single largest problem. Inflation climbed as an issue, but remains in second place. The small business optimism obviously fell slightly, with the small business outlook falling a bit further. And a lot of that is because quality of labor. So that's why when we talked about in the previous one, there's an expectation that they're going to have to increase wages to close that quality of labor gap. But can they pass on that pricing? And in August, they started to. But now they're actually starting to see sales slow down. So as sales slow, how are they going to push through those wage increases? We've already started to see that slowdown in wages, and we do see that accelerating as job quits and wage growth. So job quits, JOLTS, private quits rates is coming down, and private wages and salaries also typically come down with it. And you can see the correlations and why we see the direction of those wages and salaries continuing to fall, putting more pressure on consumers as inflation is actually pivoting back up. And again, I can't stress enough, August is not an anomaly. August isn't like, it's a blip and it's going to come back down. There's follow through. There is follow through on this increase in inflation. There is on a month over month level. And then year on year, the further we get through 2022, the easier the comps get. And you're going to see how impactful that's going to be going forward. As of August, the small businesses with job openings hard to fill continue to fall. But again, it's still elevated. It's just still well above where we've been going back to the 1980s. But at least coming lower. Now, the bite of inflation annual report on income, poverty, and health insurance coverage shows a 2.3% drop in inflation, but adjusted household median income in 2022, which was worse since 2019 and third consecutive yearly decline. So again, you're just seeing that the household median income continues to fall because of the bite from the annual report. When you're looking at income, when you're looking at poverty, when you're looking at health insurance coverage, 2.3% drop. And it's all because of the inflation that inflation piece. So when you inflation adjust, household median income came down again for all of 22. And unfortunately, we don't see that getting better in 23, given where we sit on the current backdrop of credit rates and these other pieces against that income. Percentage of small businesses saying now is a good time to expand remains incredibly low relative to history, unchanged from July to August at 6%. Credit condition components for small business survey improved in August. For now, entire drop seen during banking stress earlier this year. So again, credit conditions component improved slightly, but again, it's still at a very low end. And then percentage of small businesses saying now is a good time to expand is incredibly low. And we don't see that changing just given some of these uncertainties in the market. Hiring plans, slight uptick in small business plans to raise worker compensation. And then hiring plans, when you look in general, fairly flat. But how can you plan to expand if you can't fill what's there? And quality of quality of labor is an issue. Well, you're going to have to raise prices, but can you pass through those prices and recoup them in the market? Inflation signal price components for ISM manufacturing and services appear to be making the trough. As we've been saying, manufacturing was going to go higher, still remaining contraction, but what we've been pointing to is services is going to continue to ratchet up, and it's going to pull the manufacturing side. Now with energy prices going back up, manufacturing is going to increase, and these are the leading indicators that, inflation prices are going to be there even as wages continue to fall. Now, even if wages stay the same here or even slightly increase like the small businesses want, it's not going to offset the increase in inflation. And that's why when we talk about real wages, we continue to see that moving down. August ISM Services PMI came in at 54.5 versus the estimate of 52.5. New orders came up. Prices paid rose. Business activity moved higher. Employment rose to the highest since November of 21. So again, all of those things are not deflationary. It's also not recessionary. So that's why when we look at the different balancing acts, we've always said we are not in a recession in the U.S. We think that things are slowing. It's going to really depend on the consumer, but the consumer has been willing to this point to leverage themselves to the gills to go out there and buy things. But the number of consecutive days, when you look at the 10-year versus the 3-month, the spread between the 10-year and 3-month Treasury yields has been negative for 218 consecutive days as of yesterday, which is as of September 7th. Now officially longer than the streak that ended in 2007 and longest streak since the one that ended in 1980. And again, for those that I've been talking about the correlations and similarities, again, not the same, but similar between what happened in the 74 into 82 and what is happening at the moment. So then when we start looking at interest income hasn't risen in a big way despite an increase in Fed funds rates, which partially reflects fact that deposit rates have not yet risen as much as they probably and ultimately will. So again, it's that delay where, and I've talked about this in the past, where my father, when we were talking about when he bought his first home, he was like, yeah, my mortgage was, 18%. And I was like, well, that must have been, obviously 18%. That's crazy. But he's like, but I was getting 14%, 15% in savings. And that's again, when you look at the disconnect, you're still getting pennies on the dollar where we're going to have to see that go back up in order for people to be willing to go from money market into a savings account to try to grow some of that growth, try to get some of that growth. New York Fed survey of consumer expectations. Household financial situation is much worse off versus the year ago. Household financial situation much better. So here you can see that people are seeing things getting worse on their side. New York Fed survey of consumer expectations, saying it is much harder to obtain credit is going higher, saying it is somewhat harder. Again, you're seeing just in general that tightness, which continues to increase for the consumer. As of 2Q of 23, household net worth was up 775% of disposable personal income, a rebound from the prior quarter. And again, a lot of that is driven on the value of the home. And again, it's just because you have it doesn't, and you haven't seen a mark to market on some of these pricing. That's where we think some of that is going to come down when you look at some of that disposable income in general. But again, that'll take time to look at. July consumer credit grows 10.4 billion month on month versus the estimate of 16. Revolving credit came in at 9.6 billion, non-revolving credit at 773 million. So again, the consumer itself is still leveraging themselves up, which is why we see some of those underlying problems. As of August, the number of industries reporting growth in the ISM survey ticked up to 5, which you can see is not overly impressive and is actually equivalent or in the range that we've seen with recessions. So again, you're still not seeing a meaningful increase on the GDP on the industry side, but then there's that correlation between, well, GDP is strong. And I think this reflects closer to the problems that we continue to see on the GDI side of the equation. ISM Manufacturing came in at 47.6 versus 47. New orders fell to 46.8. That is a negative forward look. Production back up to 50. Prices paid still contracting, but at the highest since April. So this is what we've said is services were going to come down, kind of meet manufacturing somewhere, but manufacturing was going to flatline. There was going to find a level and then bounce sideways. And here's where we are. Now, new orders slipped. So that, again, points to manufacturing is not going to grow. We're not going to go back into expansion. And the question is going to be, when does that service truly cross over into contraction? And based on what we're seeing so far, that is not a likely situation in the next month or two. After a big plunge from 2021 to 2023, supplier delivery components for ISM manufacturing and services are starting to recover. So you had that bullwhip side, and now we're starting to kind of settle out right here. Round trip, the inventory sentiment component within ISM services, PMI rose in August to the highest since 2020, broadly back in the long-term range. So again, some of the key things that are happening in general, both prices paid and supplier deliveries component of ISM manufacturing turned higher in August, still in contraction, but again, some of that firming up, which we're continuing to see, we're going to continue to see kind of drive forward over the next few months. And that's why we do see the manufacturing side go above 50. We do expect it to go back into an expansionary backdrop. ISM services data through August looks like PMIs are starting to find their footing, and that's where it's just kind of that backstop where they're gonna nothing dies in a straight line. So services comes back up, kind of back to the high, but we do see that trend continuing to move to the downside. August ISM manufacturing employment component bounced back at a stronger rate while new orders moved lower. So this is, again, some of that mismatch between some of the different pieces that we've been talking about. Factory orders starting to turn a corner. Well, not particularly. It's just a matter of kind of flatlining. And that's where we've been seeing now. Some of the new orders on the ISM side came down slightly, but it's just that balancing act that we're finding here where we're not going to the 30s. We're not in the position that Germany is in. We're not, or Europe. That is in a much worse position, and some of those key pieces in general. July factory orders came in at negative 2.1% versus the estimate 2.5%. So again, just that balancing piece that we continue to see. Under the surface of Atlanta Fed wage growth tracker, much of the reversal in growth has been driven by the 16 to 24 age group. Wage growth for 25 and older groups has rolled over, but at a much slower pace. For job switchers, pace of wage growth has slowed. Current change of negative 2.8% over the past year, just slightly worse than year-on-year pace seen in late 2009. So again, you're seeing the slowdown. So it's here. but yet you're seeing the increase. And this is the disconnect that we've talked about, where things are going and the pivot that things are happening in is going to be that problem and cause that bigger slowdown. So then when you look at, as tracked by the Fed, Atlanta Fed, much of the slowdown in wage growth has been concentrated in the lowest earning quartile. Highest earning quartile has seen growth roll over, but barely. And again, you're still at an elevated level, but you're still now falling. And what we've seen is really falling below inflation. Atlanta Fed wage growth tracker eased down to 5.3% in August, slowest growth since January of 2022, but still strong relative to history. So then when the Dallas Fed trimmed mean PCE continued to underscore disinflation, with that 1 month annualized change easing to that 2.4. But it's going to be important to see PC at this point because energy's pivoted back up, and that's going to bleed down into some of these other things. So we do see that PC kind of moving back up and bouncing back up, which is going to be, I think, a bigger problem as you look at some of the policy that's going to be set up as we head into the remainder of the year. Now, I shouldn't say even just remainder of the year, but also into next year. U.S. household net worth increased by that 3.7% quarter on quarter, quite strong, but U.S. household net worth increased by that 5.49 trillion in total. A lot of that driven by, as we've been talking about, equity holdings as well as the household side. Wholesale sales year on year pace remained in negative territory. Still good to see some of that improvement, but it's not so much an improvement as we see more of that kind of stabilization at these levels. Wholesale inventory to sales ratio rolled over in July, but remains quite elevated. So again, just continues to see that some of this balancing piece and not a whole lot of movement when we look at the wholesale front and just that in general. July wholesale sales, 0.8% month on month versus 0.2% estimate. So again, sales came back up a bit, but inventories again came in at negative 0.2 versus the estimate of negative 0.1. So still seeing some movements on the merchant side, not as much on the retail front. And these are some of the headwinds that we continue to see in general. MBA U.S. purchases, mortgage purchase index from MBA just hit its lowest since 1995. And when you look at that Labor Day weekend, you kind of get that just the sheer size of that drop, which is an underlying problem, not getting much better. Year-on-year rate for HPA, you can see some of that bounce that we've seen in pricing. And it's not even so much a bounce, it's kind of that balancing act because right now we need volume. It's a volume issue because existing home sales are nothing. It's going to be new home sales and again, new rental properties that is going to help kind of pull some of that pressure off from the home side into the apartment front. So then U.S. borrowers are spending more income on mortgage payments. That is true, and it's just a matter of the typical principal and interest payments to buy an existing home as a share of monthly income. Obviously, it's the affordability side, as Freddie Mac home price index has that bounce. Homes are too expensive. Affordability is the number one barrier to Gen Z and millennial home ownership. Latest Redfin data show 18% of millennials and 12% of Gen Z believe they will never own a home. Roughly half of Gen Z and millennial renters who believe they're unlikely to purchase in the near future say high prices are prohibitive. Not surprising. The volume of mortgage applications have dropped to the lowest levels since December of 1996, which we took out, and are now at the lowest level since 1995. As the housing affordability index from remained at record low in July, going back to the 1980s. So rounding that out, when you look at the Federal Reserve U.S. household real estate assets, the most recent drawdown in household real assets values was the worst since the Great Financial Crisis. But I think that blue line puts into kind of context how much further we have to go unless we're willing to have some sort of wage increase, or a wage price spiral, which I think is the goal to be avoided. So that's what we have for you in the U.S. In the next segment, we're going to go deeper into Europe and some of the things that are happening on their continent.